right, welcome back, everyone. Our next speaker for the afternoon is Mr. Charles King. Mr. King is currently a shareholder at Sprouse, Shrader, Smith in Amarillo, Texas, where his practice primarily focuses on wealth planning and probate. He has more than 35 years of experience in these areas and works to help individuals and families arrange, manage, and transfer wealth. Mr. King received his law degree from the Texas Tech University School of Law. He is board certified in estate planning and probate law, and he is also a fellow of an ACTEC fellow. Mr. King has given numerous presentations for the state bar, and we are proud to call him a Tech Law alum. Mr. King's presentation today is titled Wealth Transfers, the Effects of Valuation Criteria. So please join me in welcoming Mr. Charles King.
Good afternoon. This discussion is going to be about valuation and how it affects not just the tax issues, or not specifically on tax issues, but how it affects your client's administration of assets, and also how it affects the estate administration relative to those of you who are in the trust departments and in executor positions, etc. The beginning of all of this was before the administration introduced its budget plan this last Tuesday. So I'll make a couple of comments as we go through this. But first of all, the administration for the second year in a row, last year as well as in this year's proposed 2015 budget, is reflective on the administration's view that all of the doors that have been opened in the estate, gift, and generation skipping tax area are opened too wide. It's time to narrow them and to close. And to begin with, they want to now reduce the estate tax applicable exclusion amount and the generation skipping tax exemption amount to $3.5 million from the current $5.34 million. One of the comments about the reason for change is that the tax cuts provided by previous acts has helped the most affluent taxpayers, and that we cannot afford to continue this situation. Secondly is that they want to increase the top tax rate to 45% from the current 40%. The proposal is that the gift tax exemption or exclusion is going to be $1 million, reduced from the current $5.34 million. They're looking for consistency in the value used for income tax purposes relative to bases, and they want to make sure it's going to be consistent with those reported for gift tax purposes and for estate tax purposes. Simplification of estate administration is going to get more and more difficult should something like this be passed, because there is, along with this current proposal, a reporting requirement by every executor as to every asset of the estate, and there seems to be no limit on the size of the estate or the circumstances. They want to ignore certain restrictions in family-owned entities by permitted Treasury regulations. This is to do away with discounts on family partnerships, family corporations, family limited liability companies, etc. What I didn't see in the March 4th proposal is anything further on these restrictions. Now, prior to last year, this was to say to disallow by statute discounts on family entity interest. Last year, it was saying, let's give the IRS the power by regulation to affect the amount of discounts. I don't know where this one's going to go. As far as grantor retained annuity trust, they say in their proposal, taxpayers have become adept in maximizing the benefit of this technique, often by minimizing the term of the GRAT to as little as 2 years, and by retaining annuity interest that results in a value of the gift being zero. This is what Congress gave to us in the statute many years ago, but because the taxpayers have learned how to use what Congress gave to us, they now decide that it is too useful and we want to do something about it. Also, eliminate zero grats. There's got to be some value for it. And two really scary provisions is that a trust, which is a grantor trust for income tax purposes, we've often referred to as defective grantor trust or IDGTs, they now want to tax the transfers from those trusts as well as tax the trust upon the death of the settlor of the trust. Again, they say the door is open too wide and it's letting too much out. An interesting thing is that they want to limit the period that a generation skipping exempt status can exist. They want to limit that to a period of 90 years. In the discussion about the reasons for the change is that when this was proposed, all but a couple of states had rules against perpetuity that were in the 21 year after death of measuring lives. Today, many of the states have either repealed that rule, do not have a rule against perpetuities, or have very long-term rule against perpetuities. And so I guess they're beginning to see that the generation skipping tax certainly needs to be applied at some point in time. I sit back there and put in $10 million into a trust, and assuming the trust department is going to double that every 10 years, at the end of 80 to 90 years, that $10 million is going to be worth around $2 to $3 billion. I guess they're wanting to grab what they can when they can. So the bottom line is that valuation issues are still going to be very, very important, even if this kind of legislation were to be passed and enacted into law. Initial comments about the administration's proposal and Tuesday's announcement is that it doesn't stand much of a chance of being passed, especially once we see how the election comes out in November. They don't see a shift in the Republican, Democratic representation in both houses. Therefore, we're probably not going to see much of this go into effect. To me, the significance is they just keep wiping away at it, and someday one of these things will end up sticking on the wall. So in the wealth transfer area, the valuation is a key factor in many, many cases, especially when the asset that's subject to valuation is a subjectively valued asset, such as closely held business interest, land, oil and gas production, etc. And there are a number of considerations in determining the fair market value of transferred property. Some of these may be standing alone, and some of these may be tiered, one on top of the other. The nature of the asset. What is the market for the asset? Valuation approach. Is the appraiser going to use market, income, cost, internal asset value, etc.? And one qualified appraiser may value totally in a different way than some other qualified appraiser. Another consideration in the value of property is the adverse or discount factors affecting the asset. Premium factors. Do you have too much of a good thing? Contractual restraints, like buy-sell agreements, federal and state regulations that may affect the asset's free transferability, such as securities regulations, the tax impact on the asset itself, so that we finally begin to see that if it's corporate stock, it's in a C corporation, and the real value of the asset is the dissolution of the company, then the tax factors can be considered. The decedent's declarations. These have become a problem for us in some administrations because the IRS agent was able to obtain the tax or the decedent's insurance policy and therefore see what the decedent claimed was the value of jewelry, rugs, art collections, and those types of things that might be itemized in an insurance policy. Recent transactions. Seen cases and have been involved in a case where the decedent had, say, 20,000 shares of a closely held company stock, and one of the employees had a divorce prior to the decedent's death, and in the divorce, the employee agreed to pay the ex-spouse for her interest in 200 shares. That 200 shares was the tail that wagged the dog in the tax court as to the decedent's 20,000 shares. How can the property be used? What are the debts related to the property? What is the location of the property? Comparable sales? All of those can be factors that can determine how the value is set by one who's qualified to review the value. The discount, as I'm going to talk about in this proceeding, is defined by me as a reduction of value of an asset that occurs because of the adverse factors affecting the asset, and these factors prevent it from being freely and readily bought and sold for an amount that would be received if the asset was unaffected by the related circumstances. So, for example, undivided interest in real estate, lack of a ready market, minority interest or lack of control, blockage, having too much of a good thing, burdens or restrictions on the sale of the asset, and the illiquidity of the asset. All of these are factors which we all run into relative to family-owned or interest in family entities. Getting to the application of valuations in the estate administration, one of the first things that comes about are the tax elections that the executor is going to consider in the administration of the estate. One of these elections is under Section 2032. This is the section where the executor may elect to value the property of the decedent as of the date of death or the date 6 months after the date of death. This election is available only if two requirements are met, and first is that at the alternate valuation date, the total value of the estate is less than it was on the date of death. Secondly is the estate tax liability must be reduced. Therefore, if you don't have an estate tax liability as of the date of death, alternate valuation is not going to be an option and probably would not want to be considered. The problem that the IRS has run into with the alternate valuation statute is that the statute says if there is a sale, exchange, or other disposition of the asset before the 6-month date, then the alternate valuation will be the value based on that sale, exchange, or disposition. The taxpayers have entered into transactions between the date of death and the alternate valuation date, which would alter the value of the asset and reduce the value of the asset, which I'll explain here in just a minute. So what the IRS has done is issued regulations that expand the definition of sold, exchanged, or otherwise disposed of. Not amending the statute, but just amending the definitions behind the statutory terms. First, they're not going to consider the exercise of stock options. Those would be considered as a disposition, and therefore the date on the exercise of the options would be the alternate valuation. Transactions involving partnerships or other entities which are similar to the surrender of stock, redeeming some of the partnership interest. Distributions by the estate of the property, and that's always one that seems to catch some representatives. It's often the beneficiaries want to get their hands on the assets. So if those assets are distributed to the beneficiary 3 months after the date of death, that is a date of disposition, and the fair market value of the asset on that distribution date will be your alternate valuation. Transfers or exchange, whether or not gain or loss is recognized. Additionally, contributions of cash or other property to a corporation or partnership or other entity, whether or not gain or loss is recognized. Additionally, an exchange of interest in a corporation, partnership, or other entity for one or more different interests in the same entity or acquiring a resulting entity. So you could get into an issue of exchanging voting stock for non-voting stock as an example. And then the nice global clause of any other change that occurs in the ownership structure or interest of the assets, such as the dissolution of the decedent's ownership, the dilution of the decedent's ownership in the entity, an increase in the ownership in the entity due to the entity's redemption of the stock, reinvestment of the entity assets, or a distribution or disbursement of property by the entity, which would result in a change of the market value. In order to make sure that there is no monkeying around, as I will call it, the aggregation rule is also spelled out in the regulations. And basically what it's saying is, if the decedent gave 70% of a 100% owned asset to one beneficiary and a 30% interest to another beneficiary, the decedent distributes, or rather the executor distributes, 70% of the decedent's interest 3 months after the date of death, and on the alternate valuation date, 30% is owned. These regulations will not allow a discount of the 30% interest. Also, these regulations, by specific example, are saying that we are not going to permit you to take 100% owned ranch or farmland on the date of death, put it into a limited partnership, then divide it up between the marital gift and the bypass trust. In that case, the alternate valuation date is the date that the estate put the interest into the partnership. Therefore, based on 100% of the value of the assets contributed to the partnership as of that date. Under Section 2032A, this is the one where the executor's estate can elect the special use valuation program. And as you will recall, in this case, the estate of the decedent must hold as 25% of its value farm or ranch or closely held business real estate. Secondly, it must have 50% of the total estate in farm, ranch, closely held business interest, real estate, and other assets used in the farming and ranching operation. The interesting thing, and this is on page 6, to be focused on is, are you better off with an undivided interest discount or a reduction in value due to special use valuation. In the first column, paragraph number 3 talks about the effect of a discount. If the decedent owned $1 million worth of property and owned 100% of it, then that property, maybe in an estate's calculation of the 25-50% test, would meet the test. However, if it was $1 million of undivided interest owned by the decedent with the decedent's sibling, then that undivided interest discount would apply. If that discount was 20% in my example, the result is that the alternate, or rather the special use valuation, would not be applicable, and you may come out with a much higher tax bill. The discussion on page 6 and 7 regarding the Hoover and Maddox cases, I will leave to your review. They're very difficult for me to quite understand the differences, but the main difference here is whether the difference in the discounted value of the decedent's stock in the company that holds the special use property is how much greater it is than the value of the special use property. And it depends on whether that difference is less than the allowed reduction under 2032A, which is currently $1,090,000, or whether that difference is greater than $1,090,000 as to whether you get the reduction under 2032A as well as a discount on the stock. The Dessous election, which is discussed on page 7, is the provision whereby the code allows for an election to allocate a deceased spouse's unused estate tax exemption to the surviving spouse. Many accountants say this makes estate tax returns very easy. All we have to do is estimate the value, and the preparation of these returns are substantially reduced. What we have found is that these returns often don't present much of a reduction in the amount of work involved. If your estate is less than the $5.34 million of exemption that's available this year, and if there is a surviving spouse, then the executor can make the election on a return that must be filed, and the value of gifts to qualified charitable and marital programs can be valued based on an estimate. And that estimate is to be rounded to the nearest $250,000. I have not had one of these returns reviewed. We've been receiving some closing letters. The $250,000 round number is not a basis number. You still have to go in and determine the date of death value of each of the assets in order to get the basis determined under Section 1014 of the Internal Revenue Code. The estimated value program of the nearest 250 cannot be used when the value of the property is relative to the value passing to a non-charitable or non-marital gift. In other words, formula gifts. The value is needed to determine eligibility for elections, such as alternate valuation or special use valuation. You can't use the guesstimate of value if less than the entire value of an interest in property is includable in the decedent's estate and is given in the form of a marital or charitable deduction. So if the decedent owned an undivided interest in land, I think you've still got to get a full appraisal and report that on the return. And if a partial Q-tip election is made, the Other thing you're running into is noted there in the middle of the column, or right-hand column on page 7, and that is you have to still substantiate that the gift to charity or the gift that qualifies for the marital deduction is, in fact, qualified for the charitable or marital deduction. So we have interpreted that in our office that we've got to go to the bank and get a copy of the joint tenancy with right of survivorship agreement. Or we've got to go to the brokerage house and get copies and proof of beneficiary designations. If it's an asset passing under the will, you're pretty well covered. But if it's an asset passing non-probate, you need to substantiate that information. And you can't just report a life insurance policy, $1 million paid to the surviving spouse. You need the IRS Form 712 for proof. If any of those exceptions apply that I just mentioned, then a full return is required to be reported. The main thing I want to point out to you about the dissue election is on page 8 in the middle of the first column. And under Revenue Procedure 2014-18, the IRS has extended the deadline for filing returns making the election to carry over the unused exemption. The decedent would have had to die in 2011, 2012, or 2013. Please note that this does not apply for returns that are due in 2014 for decedents dying in 2014. An estate tax return has not been previously filed. So if one has been filed and the election was not made to carry over, you would not be able to take advantage of this new ruling. And the estate has not filed a timely return. And this is something that is going to give all of us an opportunity to have some second looks at cases where someone died in 11 or 12 or even 13, and the surviving beneficiaries of the estate or the surviving spouse said, no, let's don't file that return, I don't want to go to that trouble, etc. You now have the opportunity for estates of decedents dying in 11 through 13, where there's a surviving spouse, to make that election, as long as you file that return by December 31 of this year. Section 303, redemptions. We don't see a lot of this anymore, but in order to qualify when the decedent had stock in a C corporation, to qualify a redemption of that stock for capital gains treatment, then the value of the stock must be at least 35% of the adjusted gross estate, so to speak. Discounts could possibly avoid meeting that 35% test. Let's talk about some penalties and problems with either overvaluation or undervaluation. And this is where we really get into the discussion with our clients. We get into the discussion with some of our clients' accountants and others who want to be aggressive in the valuation, either too much or too little. In the penalty area, you could have a problem with overvaluation resulting in some income tax penalties. And as an example, the paper talks about a ruling where the decedent died owning a $2 million piece of property, and because all of the property was given to the surviving spouse, it was reported on a return at $3.5 million. And as a result of that value, the amount of depreciation taken by the surviving spouse over the next few years was aggressive. And therefore, she was penalized for an overvaluation because her depreciation deductions were greater than what would have been allowed had she properly valued the stock for income tax purposes. As to the understatement of value, which is something much more important in the transfer tax area, gift, estates, and generation skipping tax, there is a penalty for a substantial estate or gift tax value understatement, and that penalty is 20% of the amount of the underpayment. The amount of what is a substantial understatement is if the value of the property is finally resolved with the IRS was reported at 65% or less of the amount finally determined to be correct, then you have a 20% penalty on the underpaid tax. I think this is part of what happened with appraisers. We are seeing more and more 35% or smaller discounts where we might have seen much larger discounts just 4 or 5 years ago. And part of that is because the appraisers are now subject to these penalty provisions for understatement. And you know, a substantial understatement is 65%. If the appraisal of the asset, such as the land, is determined to be off by 10%, suppose that the land was appraised at $900 an acre and the finally determined amount is $1,000 per acre. Further, suppose that it's an undivided interest in the land and that the appraiser put a 30% discount on the undivided interest. The result, if you go through that calculation, is that the land as reported was 62% of the total resulting determined value by the IRS. The other thing we're starting to see that's giving us some problems in our shop is that the appraisers want to give us an engagement letter that indemnifies them against any and all liability except for their gross negligence. And that is just a real problem. I mean, thinking we hire the appraiser to do the job for us so that it holds up with the IRS, and we get down the road and we expect the appraiser to be qualified, to know what the appraiser is doing, and to have properly prepared a report that's going to meet the qualifications that we need to present it to the IRS and uphold the value as presented. Why should we be, and the taxpayer, be indemnifying the appraiser for mistakes that are certainly subjective in the appraiser's point of view and would be very difficult? Additionally, indemnification against any damages that arise out of the engagement, that's a problem because the appraiser's program may result in that appraiser being barred from testifying before the IRS on any tax matter for at least 3 years. Are his damages going to be the lost appraisal fees that the appraiser doesn't receive over the next 3 years? The appraisers that are presenting our clients with indemnification letters or indemnifications within the engagement letter are not willing to back off of those paragraphs. And I think we're going to need to educate these folks. The penalty for understatement of value increases to 40% if the understatement is a gross valuation misstatement, and a gross valuation misstatement is when the value stated is 40% or less of the correct value. So the days when we used to be able to sit down with the client and say, okay, we're going to fill out this estate tax return, what do you think the property is worth? And the client says, I don't know, I wouldn't sell it for less than $1,500 an acre. Well, I know, but what is it worth? What are we going to put on this return? Well, you sure can't make anything on $1,500 an acre. It's just not worth that. Well, I know. What do you want to do? Well, put it in the return at $7.50 an acre. And we know the IRS will come back at $1,000 an acre. And then we can dicker and settle. Those days are gone. And we've got to persuade and convince our clients that they do need a qualified appraisal from a qualified appraiser in order to protect themselves. I'm going to kind of zip through this next part, but what I'm going to do is say, be sure and look at the provision, the discussion in the article about qualified appraisers and a qualified appraisal for income tax purposes when taking a charitable deduction. They are onerous, and I think that too many people are being too slack in approaching the charitable deduction appraisal approach because it is extensive. The regulation is in Exhibit A of the paper. A case evidencing this is noted to you on page 9, the Evanchik case. And in that case, the taxpayer owned 100% of the stock of a company that owned 2 apartment buildings. He had the apartment buildings appraised. He gave 72% of the stock to the charity. He took a deduction based on 72% of the value of the apartment buildings. He did not produce an appraisal of the stock that was given to the charity, and the deduction was disallowed. Another very important part of our representation of clients, especially in the gift tax area, is to stop the ability of the IRS to revalue previous gifts and thereby increase the amount of previous use of a client's exemption from estate, gift, and generation skipping tax purposes. The regulations mentioned to you on page 10 and 11 are critical insofar as what is required as to the valuation of an interest of property given and reported on a gift tax return. This is talking about undivided interest of real estate. This would be talking about gifts of family limited partnership interest, corporate stock, etc. The difficulty that we ran into in 2012 when everybody was giving away everything and the dog is that the appraisers would not comply with the regulation requirements in order for us to use that appraisal for the client's purposes. It's often difficult to go back to the appraiser and say, get your appraisal up to speed, fill in these instructions. So what we have begun to do in many cases is make a copy of these regulations, send them to the appraiser, and say, be sure your appraisal dots the I's and crosses the T's, shows your qualifications, shows your experience, shows your valuation method, etc. Values can be a real problem when we get down to gifts under the will. Well, I'm sorry, get through this. But I'd like to talk to you real quickly about the Proctor case, which is talked about on pages 12 and 13. And this is Proctor. It's a tax court case. You're not going to find any appeals. The typical Proctor case you hear about is the one that goes along with the Wandry decisions and the formula gifts, and that's Procter. In the Proctor case, the decedent owned all of a ranch, 60,000 acres. And When the decedent died, he gave the 60,000 acres to Texas Tech. He also had a provision in his will that said, I give my foreman's wife the right to lease this ranch at full market value to be determined under reasonable negotiating arm's length circumstances. The value of the ranch at $6 million, I said 60,000, I think it was 6,000. No, 60,000. The value of the ranch was $6 million. In the decedent's hands, unaffected by the lease right. However, your charitable deduction is limited to the value of the gift to the charity, not to exceed the value included in the estate. The value of the gift to the charity was determined by the tax court to be that value based on the $6 million ranch, discounted for the lifetime lease right of the surviving wife of the foreman. The result was, round numbers, $6 million inclusion, $4 million deduction, and the estate paid estate tax on the difference. I told you I'd give you some more time back, so I'm going to very quickly say that these discount factors and so forth really get into play regarding impartiality, how you fund the gifts, etc. A good example of that is the discussion about funding some generation skipping gifts, which are discussed at the bottom of page 15 in the right-hand column. Community property really produces some issues, especially because the 50-50 ownership is just automatic. So how many of you discount the gift of the residence to the surviving spouse of a community one-half entry? Don't raise your hand. I don't want to be joining you. The community property factor, though, does produce some discount issues that should not be overlooked, but at the same time could be problematic insofar as funding charitable and marital gifts. And then finally, there is a discussion in there about the deduction of unliquidated and unsettled claims and what the IRS is doing regulation-wise as to whether and how those can be deducted. Thus, the reason you see on your Form 706 these days a box that you can check as to whether you want to make a protective election to deduct a claim that is resolved more than past the statute for filing a claim for refund. Thank you.